Yeah, so let's go ahead and get started with today's presentation. First, we always want to begin with what is PowerOptions. Well, PowerOptions is a patented suite of search and analysis tools for self-directed options investors. Our tools allow you to search across the universe of options to identify only those positions that match your risk-reward tolerance in a given strategy. We support over 23 of the most commonly used option strategies. We also offer tools to help you further research, analyze, track, and manage the position with our portfolio tools and other tools as well. Of course, we also offer countless help videos, white papers, articles, and archived webinars to help you get more familiar with the tools on the site and the various option strategies. Ernie Zarena created PowerOptions back in 1997, but everyone here on staff, myself included, uses these tools to trade their personal accounts, so we have many more years of combined trading experience. All right, our process and procedure for our open discussion Q&A. When you logged on to the webinar, the GoToMeeting, GoToWebinar platform would have appeared on your screen, a little sidebar. Inside that sidebar is a question pod. Just use the question pod to send us a question at any time during the webinar. We are scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time, but if we have a high volume of questions, I'll be more than happy to stay online to make sure all questions are handled. Your questions can really be about anything related to options. If you have questions about a general option strategy, what should I look for when building a diagonal calendar spread or even a covered call? What are the steps in the underlying stock criteria I should look for when doing a naked put or a bull put credit spread? That's all fair game. You may have questions, of course, about trade management since we are at expiration. What could I have done to roll my position or adjust my position? What should I look for as a trigger point when rolling or adjusting? You, of course, may have questions just about option specifics or options basics. What is delta? What is gamma? What is theta? What is probability? What does it mean to be in or out of the money? That's all fair game. Many of you might have questions about the tools on PowerOptions or, of course, the concepts of the limited risk radioactive trading techniques. Our basic ground rules, don't be shy. Please feel free to ask any questions that you want at any time during the webinar. We are going to start the presentation with one or two quick discussions, one from email and one from a discussion I had this week. And then we'll get to the questions right away. Now, be patient. There may be one or two questions ahead of yours, but as I mentioned, we will get through them all. We also encourage you to feel free to help us help others. Now, a question comes in, I'm going to give an answer based on my market experience, what I've done in my personal account, of course, and what I've had with discussions of other options traders since 2001 when I started working here at PowerOptions. But if you have a different insight, a different way of looking at a position, send that to us. We'll share it with the rest of the audience. I may ask you for clarification on your question. There's a lot of different names for lots of different strategies that are thrown around. So just be patient with me. If you tell me, hey, I'm doing a double hedged back jade lizard condor, well, I might ask you to specify what that means. Because off the top of my head, I'm not clear on what that is. There's no problem. We'll get to the bottom of it and we'll figure it out. Most important, let's have fun. It's the end of another long trading week. Sam says, hello, Mr. MC. Good afternoon to all in the room. It's had some good puts on Apple the past 3 days, SPY and DIA. It's had a good week. Ben says hello, everyone, as well. And Ben has a question, and we'll get to your question, Ben, just after we go through our discussions. Now, I'm going to start the discussion related to search results from the PowerOptions screens and the general market conditions. This week, I had a discussion with a PowerOptions customer. She used the feature to get her search results by email. So anytime you create a search in a given strategy, you can select to have those emailed to you at any time during the trading day. So she was setting up bull put credit spreads, and she wanted them sent to her at 10 a.m. This has been working well for the last year. However, in the last few weeks, she stopped receiving them, or she'd receive maybe one a week, but wouldn't receive one on Wednesday or Thursday or Friday. And she, of course, wants to know why. Well, first, we did not change anything on the search, nor did we change anything for the get results by email. She was doing a good search that I liked, had the same criteria I would look for. She was looking for bull put credit spreads. 1 month out to the next standard expiration, so she was expecting to see May expiration the past few weeks. The short put for the bull put credit spread wants to be 7% out of the money and have a 75% probability or higher of expiring worthless. All things, of course, we can set in the PowerOptions search tool. Minimum 35-cent net credit, 5% return, and she wanted the strikes to be 5 points apart or less. She had a requirement for option volume today of greater than 10 contracts, open interest of 50, good criteria, and looking for uptrending stocks on her preferred stock list, which had about 50 stocks in it. She also was looking for earnings per share growth greater than 5%, relative PE ratio, and good broker recommendation. A pretty open search for 1 month out, restricted mostly by the stock list itself and then some of the stock criteria. So if no results can be found when the system runs that search at 10 a.m. for the email, an email will not send. It's not going to send a blank email. So for the past year, she had been receiving emails every day with maybe up to 8 to 10 to 15 possible bull put credit spreads each day. Why is she now seeing no results? Well, there's two factors. Many of the options that were 7% out of the money and 1 month out aren't actually that active. All right, they didn't have the minimum of 10 contracts traded by 10 a.m. Later in the day, when I pulled up her search, there might have been 8 or 9 bull put spreads that matched her criteria, but at 10 a.m., there wasn't enough activity on the sell option and the buy option to where both had the minimum 10 contracts. Now, of the 50 stocks on the list, there were only 12 that matched the stock criteria for the broker recommendation earnings per share growth. And this morning at 10 a.m., of course, and later in the day, of the 12 stocks that matched that in the list, only 10 total options on the 12 stocks had the volume and open interest needed. But the combinations of those options that had it, if they were on the same stock, did not result in meeting the net credit that she was looking for. They were 29 cents, even for a 1 month out bull put spread. They were smaller credits. So that's some of the factors, but the main component is the current market conditions. The customer said she had multiple spreads every day for the last year, last 8 months, but hasn't been getting emails in the last few weeks. Well, here's SPY for the last 8 months, from about April 20th, 2017, right around $235, to January 30th or so, 2018, when it peaked out at about 286, 286.20. That's a 22% gain in an 8-month period. So naturally, with little hiccups here and there, but not that many, but this was a very conducive market for identifying bull put credit spreads, covered calls, naked puts, bull call debit spreads, of course, diagonal calendar spreads, just long calls, and even married put positions, right? But here we are in the last 3 months, and there's something kind of troubling we're seeing that Sam pointed out to me earlier this week in one of his emails. Sorry I didn't get back to you, Sam. I was working on another project. Let me get a good pen color here. There we go. Starting at about February 5th is when we had that volatility whoops, that big whoops for volatility. And we saw the markets, broad-based markets, drop from that high around 286 all the way down to about 254. Okay, so it's about a 32, 33 point drop in about a 10-day period. Now we get to recover a little bit, then hesitation, get to recover a little bit. So we go back up to 280 and pull back here to 265. Go back up to 280 and then pull back to that 255. And we sort of peaked out the other day at about 270 and then had 2 down days. Now what I meant by what Sam had said that was kind of concerning is we're starting to see lower lows in SPY and lower highs. It didn't make it back to 286. It didn't make it back to 280. So that's kind of a concern there that Sam rightfully pointed out as something long-term looking. We're seeing lower lows and lower highs on the recovery aspect, and that can point to some dangerous things from time to time. But let's look at the overall view. Right? Here's 2 years of SPY from 210 back on April 20th, 2016, up to 285, 286, and then we're here. Okay, so this market, we're also seeing a lot of things snap openings. Up 50 points, maybe up 100 points for the Dow, SPY for example, then the next morning down 85. Next morning down 65. Next morning down 125, down 200. Then up 50, up 60, up 70, down 150, down 125, down 80, up a little bit and then down. So there's a lot of these snaps that are occurring where what worked for the searches and was very profitable, again, covered calls, naked puts, what worked over this period, the same criteria is likely not giving you the same number of results or the same quality of results that we've seen in the last 2 years. In fact, the last time we saw this type of turbulence was back September 2015 to February 2016. It was about 2 years ago. Okay? But right before the big run, that 18-month run or so, look at what we see here in September. From August down, it just drops, drops, drops. Then it decides to come back up, holds for a little bit with some different adjustments in there, and then it goes back down again and is testing newer lows. Right? Almost similar to what we saw here, the big spike down. Here it was from 210 down to about 185. As we mentioned, we went from 285 here down to about 255. Well, then it tried to recover, came back up, went back to almost where it was, and then drastic down again to the 180s. And here we tested that again at the 250s, and now it's trying to come back up, but it didn't quite make it back up to the peak. Now, I'm not projecting that we're going to see another 18 months of this after this turbulation like we saw back here. Okay? But what I'm saying is the current market now is not going to give the same results that you had with strategies that worked in the past 12, 6, 18 months. Okay, it's going to be a little bit different. Last 2 years was great for all those bullish strategies. And you could find bearish positions out there too, don't get me wrong. We'll take a look at one of those in a moment. This last 2 months is not so much. Yes, volatility has been jumping around and that's good for premiums, but it affects the probability. It's going to affect the number of stocks that are above their 20-day or 50-day moving average and looking for the trends you want for a neutral to bullish or bullish strategy. The snap opens up and down are also going to affect the range out of the money for an out-of-the-money credit spread or an in-the-money debit spread. You might have ones that are hovering just at around that 7 or 8%, saying, well, it's not coming up in my results. Why? Because of the open, it pulled it down too much, or the probability shifted too quick. And also because of the volatile nature of the market, and I know many of you online are doing this, but the activity, the volume is much higher in the near-term options, especially the week heading into a standard expiration. All this week, people are probably buying or closing or even selling this Friday's options, even buying this Friday's options, or rolling the Friday options they have for a profit or to avoid a loss out 2 weeks, maybe out 3 weeks, but not all the way out to May expiration. Still good positions out there 1 month out, don't get me wrong. But to expect to see a good aggregate volume by 9:45, 10 o'clock every morning might not be such a good idea. So why am I mentioning this? Well, it showcases some of the features on PowerOptions, the ability of the search criteria in any strategy, the ability to get your search results by email. And of course, some of you may have had a similar experience with your own search results where starting in December or maybe from October to December or to January, you'd run your covered call search and you'd get 12 or 15 that matched your criteria. And then in the past 2 months, you're seeing 2, maybe 3. Okay, and it's because of the market conditions. So is there a fix? Well, you may have to adjust your criteria with an eye to the current market. Open it up a little bit. Another idea is to create 2 searches. You have the current one that you have if you're having those emailed to you, and then make 1 or 2 changes on that search. Create another search in your strategy, so you have the 2 now, and have them both selected to email to you and compare, are you getting results on one of those searches but not on the other, and that will give you a better gauge going forward. Okay? All right. Now, quick question from John B. We'll go over this quickly. It's a good question. But he says, how does IV affect the delta of calls and puts? When should you buy or sell calls and puts based on IV? And should you buy puts and sell calls when IV is low and vice versa? What is the best indicator to use to track IV? Okay, we're going to take a look at that very quickly at Power Options, but first, when should you buy or sell calls and puts based on IV? Should I buy puts and sell calls when IV is low and vice versa? My opinion, don't buy or sell based on IV alone. We have an archived webinar. Yes, it's about 3.5, 4 years old, but it's called IV, the double-edged sword. If you base buying and selling, you want to base the buying and selling of calls, or puts on the direction of the stock, not on high or low IV. Because no matter what your implied volatility is, if the stock does not move as you need for the strategy you opened, your IV won't matter. Sure, selling into high implied volatility is deemed better because you get a better premium. I'm not saying that it's not a better premium. You get more bang for the buck, but it has a high implied volatility for a reason. There's something coming up that could cause the stock to swing wildly. And if you're in the wrong direction of that wild swing, yeah, maybe you got a little bit higher premium, but you're still in a losing position. So I personally do not look to buy calls or sell calls solely based on where is the IV. And then, of course, the best criteria to track implied volatility for me is what we have on Power Options called the percent implied volatility range. It's not just a measure of what is the implied volatility right now. The percent implied volatility range shows you where is the option's implied volatility now compared to where it has been over the life of the option since the option was released on the market. So when I'm selling, I do prefer that the implied volatility range is up above the 60%, 65% or higher. It's in the higher range of where it has been over the life of the option. Whereas when I'm buying, either for a put option for protection in the married put radioactive trades, buying a call for a diagonal call spread or buying a put for a diagonal put spread, or just buying a call or put, I like the percent implied volatility range to be below 45 or below 50%. I want it to be in the lower range of where it has been over the life of the option. But to the first question that John answered, how does it affect the other things as well? Let's go ahead and navigate over now to Power Options. And we're going to take a quick look at a search I created a few moments ago for covered call positions. And I actually have to, there we go. I actually have to do something real quick too. Give me 1 second. And there we go. I hadn't turned off the phone yet. Luckily, we hadn't had a phone call, but if we got one, it would ring on. Okay, so here we are at the Power Options tools. And I'm going to go into covered call, and let's just go into search. Okay, and this isn't necessarily buying or selling, but it's going to give us the exact comparison we want to see. What I've done here is I've created a pretty basic search, played around with some numbers quickly, but I went out to May so that I'm looking at all 4,400 optionable stocks, indexes, and ETFs rather than just looking for next week. Minimum downside protection, minimum percent if assigned, but I just want the one strike out of the money for stocks that are trading between 1420 and 1460. 4 criteria, very quick to enter. And then what I did, as you can do with any strategy, is I used the Choose Columns feature here to select the data that John was interested in. Implied volatility, percent implied volatility range, volatility of the stock, ratio, delta, gamma, daily theta, and so forth. Vega, up, and rho. They're supposed to be over there further, but they're not. Why am I doing this? Let's take a look at the results here real quick. Let me scroll the screen down a little bit better for everyone. There we go. And let me get my pen ready. So at the very top of the list, we have Super Value Incorporated. I don't know what they do. Not concerned about it. The stock's at 1436. The May 15 strike, 28 days out, as an option bid of 0.75. But the implied volatility is at 0.6679. Okay, that's for the option. Now, all of these are pretty much in their lower implied volatility range, 26%, 25%, 23%. And that's due likely to the fact that we had a lot of volatility from March 20th to April 4th with the market pulling back on the trade war fears and other outside effects. Okay, so a lot of these had maybe spiked. In fact, I'm missing one, which I really wish was here, but we still get a good idea. Before the webinar started, I ran this search, and the top one was a different stock, which had an implied volatility, what you might call over 100. It was 1.135, so it's about 114% implied volatility. Some might call this 66%. We show it as a decimal. But let's look at it. 1436 for SVU, 1431 for GG, Gold Corp. May 15, same strike, almost the same stock price, half of the implied volatility, 0.3134 versus 0.6679. Well, naturally, that affects the premium. Almost same stocks, same expiration, almost same stock price, same expiration, same strike, 75 cents for the super value, 23 cents, more than a third less for Gold Corp. Now, the stock volatility, of course, affects that too. Super value has a stock volatility of 0.53, 53%, GG's at 30%. But how does it affect everything else? Well, naturally, we've got the delta. Almost the exact same price stocks, same strike, same expiration, volatility of 0.679. We see a delta of 0.44, same range out of the money. Okay, when you have a higher implied volatility, it's going to increase the delta, which in theory means it's going to lower the probability it's going to be assigned. Okay, or in that sense, you could look at this as a 44%. Well, it increases. I'm sorry, I was looking at it the opposite way. It increases the probability as well as the delta for a call. How about the put? So at 0.27. Not quite half, but it's pretty close. And naturally, you're going to see changes in gamma. The higher the implied volatility, the lower the gamma, and the higher the gamma on the lower implied volatility. Now that comes into effect. There's a question that came in from Ben saying, what is gamma risk? Well, gamma, of course, let's see that here. Your gamma, sorry about that. The gamma here, we'll just read it off, is the rate at which the delta changes as the price of the underlying changes. Okay, so what does that mean? Well, if the stock moves up 1 point, we'd expect this option on SVU to gain about 44 cents. But then the delta is only going to change by 0.15. Okay, so this would go up to the new delta if SVU goes up to 1536 would be 0.59 roughly. Okay, whereas with Gold Corp, our delta is only 0.27. If Gold Corp goes up to 1535, we'd expect this option bid price to go to maybe 50 cents, almost double. But the delta will now change expectedly by 0.32. So that means the delta would almost jump up to as high as where this one is now. Okay, so what is gamma risk? Well, it depends on what strategy you're in. All right, so if I sold this call on Gold Corp, okay, and I wanted it to remain out of the money, and I'm using a delta stop of 0.5, the gamma risk means that if the stock moves up 1 point, this gains 32 cents or 33 cents, I'm going to be right there with a 1 point movement at my trigger. Okay, gamma risk to me is usually done in context of the movement of two options, whether you're in a spread or specifically a calendar spread. How are the two deltas supposed to change? In a sense, what I mean by that, Ben, if I'm in a diagonal spread and I've got a delta of 0.6 for the 2 month out or 3 month out option that I bought. I'm sorry, my mouse has got something in it, I think, so it's not writing as cleanly as it usually does. But let's say my long option's at 0.6 and my short option's at 0.2. Well, if the gamma on my far out in the money call bin is only 0.15, as we see up here with super value, that means for a 1 point movement, this will go up to 0.75. The new delta, and that's still good. But the delta on my out of the money option, what if that's at 0.32? That means that this is going to increase. Really what it's saying is that the actual price of the short option, it'll double faster than the long option. Okay, so that's when it usually comes into play to me. I don't play it around too much, but that's what they refer to when they're talking about the gamma risk. Naturally, theta has to be higher on something that has a higher premium because it's the same 28 days. Just showing you the expected rate of decay per day. We've got to make up 3 times as much premium in 28 days, so that's going to be higher. Vegas are going to be different, and rows are just too small right now to even bother. I just added that as well. Okay, so that's how implied volatility affects it. Is this the best trade of these listed because it has a 75 bid for almost the same stock price, same out of the money range, and same premium? It gives you the highest premium, but I can't tell you if it's the best trade until I do more research and analysis. I'm going to take a look at the stock chart, see where SVU has been. Why is its implied volatility so high? Does it have earnings coming up? I can take the stock research or just go to the company information news. Maybe SVU has earnings coming up by the 18th of May, and GG, of course, doesn't. Okay, so that's why some of these are higher than others. Why is the implied volatility higher? Because it implies there's something coming up in the future. Should I sell a strangle or straddle on SVU because it's overvalued? Even if I go with the 16 strike call out of the money and the 14 or 13 strike put because of higher implied volatility. Well, I'll get a better premium, but if the event coming up causes SVU to drop down to 12 or to move up to 17, those aren't good trades regardless of the volatility. Yes, they gave you a better hedge for the premium, but why play an event coming up? Okay, and you see, of course, here the percentage if unchanged and downside protection. SVU is a 5.6% premium against the stock price. GG is only 1.7, and that's for 28 days. Okay, sweet spot's probably right in here somewhere. Well, 3 to 3, 2.4 to 3.3. But there's something coming up. You've got to research and analyze it. Oh, and by the way, to answer your other question, John, we talked about how it affected delta, and we saw that, of course, you're going to have a higher delta if you have a much higher implied volatility comparing similar stocks. You're also going to have a higher probability because it could swing more one direction or the other. All right, so there's a higher probability that SVU might jump up above 15 and get assigned, whereas here we've got only a 25% probability because the stock and the option have a much more reasonable and lower stock volatility and implied volatility. So that is how volatility affects delta, gamma, probability. I don't trade off of implied volatility. If I'm opening a covered call, and I know this isn't what you were talking about, John, you're talking about buying or selling, but the implied volatility is something I'm going to use to say, hey, that why is this one so much more than the others? And I see implied volatility, and right away I say, there's something coming up. I need to research it to figure out what it is. I don't look for implied volatility when buying or a call or buying a put or buying a straddle. I may look at the implied volatility range for both options to see where they are in relation to where they have been over the life of the option. But again, it's not something I do. If I'm buying a call, I'm first looking for a bullish stock, a growing trend, strength in earnings, good growth for the company, and something that shows movement. I'll take a look at the implied volatility after I have my results. I don't personally do short strangles, but if I do a short strangle where I'm selling an out-of-the-money call and out-of-the-money put where I don't have the outside wings for protection as I would in an iron condor, I'm looking for stocks that are stagnating and by definition would have a lower stock volatility and a lower implied volatility. The premiums might be boring and lower, but I'll have a better probability sum, the sum of the two probabilities of being successful on that trade, because the higher premiums may have a tendency to swing more wildly, be on a stock that swings more wildly, and I could break through my short call or my short put. I want volatility. I like selling into volatility. I like buying into low volatility, but it's not my first go, and I don't play an option strategy based solely on volatility. My option strategies have a direction: neutral to bullish, neutral to bearish, neutral period, bullish or bearish. I don't do delta neutral or gamma neutral trades myself. I do diagonal spreads, but I don't force them to be delta or gamma neutral or ratio spreads, where this might come more into play. Okay, but there's the answer to your questions. How does it affect delta? How would it affect probability? Bins pop in of what's gamma risk. You can see it here, what you're expecting, that this option might double faster if there's a 1-point movement because it's already so low. When you have that higher implied volatility, you'll see a lower movement gamma to affect the delta as well. All that being said, one last thing, if you want more information on my thoughts here, go to the webinars page at any time, right? It's a free public page, don't have to have an account or be logged in. It's powerop.com/webinars.asp. I'll send everyone that in the text link. Under the options concepts category on the webinars page, things for weekly options, manage your broken position, but down here from 2014, implied volatility, the double-edged sword. And this is where we talk in depth, see more comparisons, the implied volatility, what you might want to look for, and why we personally feel that looking for the stock itself, the direction of the stock itself, is more important than what the implied volatility is or the implied volatility range as well. Okay? And let's see here. Oh, let's say, James says, but then are you just better off being directional on stocks themselves? No, I don't think so, because options give us a way to not only protect stocks or protect other options positions, but also generate premium, which you can't do by the stocks yourself being directional. You want to have a market gauge. Now, all that being said, James, I'm not saying that you just want to expect the market to go one direction or the other. A few weeks ago, Sam had mentioned that in 2018, he has a 60% return. It's probably higher now, but he had a 60% return. And what he's doing is buying calls and buying puts, but he's basing it in a straddle, legging in and out of a straddle with selling a call and put mixed in. Okay, he watches the market more than I do. That's why he's constantly doing positions. I don't want to say constantly, but he's going in and out based on market trends and so forth. So he'll follow SPY. He might have a strangle open, but he'll sell to close his put if he thinks it's bottomed and is reversing. And then as it starts to move back up, he might buy a put at the high, or when he sees a MACD crossover compared with stochastics and other things he looks at, and then sell the call when it's at the high for the most premium, buy the put, and as it goes down, buy the call. So he's going in and out, and then when he feels it's neutral, he might sell a call or sell a put out of the money against it. And he's doing, I will be honest, he says he's got a 60% return. I believe him. I can't verify it, but I don't need to verify it. I believe him completely. But the point there, I'm sorry, James, is that he's not basing it solely on implied volatility either. He's following the movements, doing profitable straddles, strangles, and selling premium based on timing, not necessarily IV. And that being said, James, too, a few weeks ago, we were talking about the VIX position, and I had a VIX call to protect my portfolio that I bought in January. When February 5th and 9th hit, it was almost a 300-400% return on that option to hedge my portfolio. I lost on 2 bull puts, made more than that on the, I think, 8 or 9 contracts I had bought on VIX calls. Because I bought the 14 strike calls when VIX was at 12. By the end of that February movement, it was up in the 30s. Okay, so, but after that, when I closed those VIX calls, I didn't protect the rest of my portfolio going forward at that time by buying more VIX calls because they were too overpriced. The volatility of the VIX was way too high. They're way too overpriced. So we looked at maybe debit spreads or credit spreads using the VIX options to help hedge the portfolio as opposed to straight buying a call or buying a put because they're very overpriced. Okay, so I might not have answered your question directly in regards to that, James, but I'm not saying that just buying stock and going directional is better. What I'm saying is that I want good premium. I want good options positions. I'm not going to, well, I might now because it had a good drop, but a lot of investors tell me that, a great stock to do an iron condor on is IBM, because IBM doesn't tend to move that much and has really low volatility. Well, yeah. But doing an iron condor on IBM, you're probably getting half the premium as if you did an iron condor at Starbucks. It's a trade-off. You've got to find that middle ground, and that's sort of why we set up our default searches that way. So we see positions that have a good premium, but aren't stable to neutral. 3-month run, even through the worst of it, is 165 to only 155. But then they just had some bad news. Looks like a good put play if this trend continues. It's not market advice. That's not trading advice. But there we go. Okay, let's get back to our other questions. Handled bin already. And I mentioned James' question because it came in with the discussion there. And we've got a couple of other questions that came in. All right, there we go. Good. Now, John, he says, I'm not sure if you already commented on this strategy previously, but what's your opinion on the poor man's covered call, long leap and selling 1 to 2 month out calls? Calendar spread. Okay, I call it a calendar spread. That's the name. Poor man's covered call, obviously a marketing term. I'm not saying there's anything wrong with using a marketing term because, you know, I promote radioactive trading, which is a marketing term. It's a married put with 12 different income methods, but it's still a marketing term. But that's okay. Poor man's covered call, substituting a leap option for stock and selling near-term calls against it. It's a calendar call. All right, there's two forms of calendar calls, of course, John. There's what's called diagonal and horizontal. What's the difference? They're both calendar spreads. A diagonal spread is buying an in-the-money option, could be 2 months out, could be 6 months out, could be a leap, and then selling at or just out of the money near-term calls against it, which could be weeklies or could be 1 to 2 months out, as you mentioned, John. I am a fan of this strategy. I have traded the diagonals. Oh, I'm sorry, the horizontal is more like this. A horizontal is, let's say we were looking at a stock trading at $50. I might open a diagonal or poor man's covered call, John, by buying a January 2019 40 call. Cost me maybe $12.50 or $13. Okay, let's put 13 there. That's fine. You know, $3 for time fee. It might be a little bit more than that, but that's okay. And then I'd probably be selling a 52.50 call for May, maybe for June, and maybe getting $1 to $1.80, somewhere along those lines. Okay, but the idea is I don't own the stock, but I own it in the money. The horizontal is also a calendar spread. It's just different in the sense that if your stock's trading at 50, you're buying a January or maybe October or September 50 at the money, and you're selling a May 50 at the money. So same strike spread or horizontal. Gives you sort of a tent profit and loss chart. I'm making the distinction because I trade diagonals, poor man's covered calls in a sense. I have for many years. It's called diagonal spreads. I like them, but they are very tricky, I find, over time. In this type of market, too, if it recovers and it goes back up gradually, as we saw in the 18 months prior to February of 2018, it is a very profitable strategy. When I started trading diagonal spreads, it was probably 2004 or 2005. Not that you need that, but it was about that time. And in the first maybe 8 or 9 months of trading, diagonal call spreads and diagonal put spreads were the most profitable monetarily and percentage-wise of any option strategy I've ever traded. The 3 months following that 8-month period, diagonal calls and diagonal puts were the largest losses percentage-wise and monetarily I've ever taken on any option strategy. Okay, I do enjoy the strategy. I still play it. What I mentioned now, John, is when I said you could have a leap option, or it could be something that was 3 or 4 months out and using weeklies. That's kind of what I do now. 15% of my portfolio, almost 20%, is dedicated to diagonal spreads at this time, both calls and puts based on market movement. Okay, I can't lie to you like that. I don't think I've opened a new one since I had to close 2 during the March 20th initial pullback to April 4th. I haven't opened any since I closed the 2 on April 4th. So I don't have any open right now, but I have been trading them actively. But anyway, John, I'm going about 3 to 4 months out and trading weekly options that are 2 weeks out, 10 to 14 days at a time rather than week by week. And similar to what I do with the bull put spreads, mine are 2 weeks out instead of 1 week out. It is a leveraged trade. Despite the fact that it's not a credit spread, which is near-term expiration, despite the fact that it's maybe doesn't have an 8 to 1 or 10 to 1 risk-reward ratio, it is still a leveraged spread. And you're using leveraged options. A 10% unexpected decrease in the underlying stock price could result in a loss of 30 to 40% of the value you have in the long haul. And you say, well, you can always roll it down. Well, sure. Okay, so let's take a look here. I open up a diagonal spread. Am I on the right one? Yeah, close enough. Don't want to take Etsy. although that's close. But let me go to the profit and loss chart on Etsy. The diagonal spread that came up here, sorry folks, that's not what I wanted to do. There we go. Okay, sorry about that. I restarted my computer before the webinar. So why am I looking at this? This is a May 35 call. The stock's at 30.01, May 35 for 45 cents. The 22.50, 7.5 points, and the money is 11.75. So I'm paying about $4.25 time premium for that January, it's 2020. Okay, well, I'm on Etsy, but let me clear this up. I'd go January 19, and it only has the 25. So I'm going with the, no, I'll go with the 22.50 call. That's better, 9.40. It's about $2 a time premium, John. And now we'll go back to May. Bad example. I wanted a 32.50. I can't sell the 30, but I want a 32.50 and it doesn't have it. That's why the 35 appeared. But I'm not going to play around too much with it. So this is good because it gives me, it'd help if I sold it, right? That'd be good to go, John. All right. There we go. So in the first right cycle, it shows that I could make 50%. But that is based on the stock going up to 35, so I'd have the 5 points gain on the position. Normally, when I sell this call, I'm not this far out of the money. I'm probably trying to be at a 32.5 if it was available, or if there's single strikes, I might be at the 32 or the 33, somewhere in that range. Okay, a little bit out of the money for growth, but still using the position. This one's a really high, but in order for that to happen, it has to go here. That does take into account the remaining value of the long option, both time and time premium and intrinsic, okay? But just like any position, it's similar to poor man's covered call, the risks on this position can catch you quickly, okay? Stock's at 30.01. What happens if it drops down to $27? Sorry about that, folks. What happens if it drops down to $27, 10%, somewhere near the first expiration cycle? You paid $9.40 for the call and got 45 cents against it. Your debit was about $8.95, right? The value drops to $6.78. You've almost lost 3 points, or 33% of the value on this position, the loss of 307. Okay, well, it's a loss of 307 monetarily. You didn't take the 10% or the $300 loss on the stock if it dropped 10%. But you did lose closer to 33% on the long and almost the same monetary loss. If you just bought the stock at 30 and it fell to 27, you'd be down 300. You're here with the leverage as well, but that's 33%. That's more than 33% of what you put into the position. Oh, no. Jeez, sorry. Let's do that again. It's not as bad as I made it look, but it's still the lie of leverage. And a lot of investors say, well, there you go, that's better. It's still 215, but it's 25% almost of the 895 you put into the position, the total debit. Lie of leverage works both ways. Looks great on paper, looks great on the return. You're using less money, so that's great. You're using less money because of leverage. Always keep that in mind. As another rule of thumb, something that I already have set up for you in the default searches and the diagonal spreads, anytime you open a poor man's covered call, you always want to make sure, and this is a setting I have here, that the net debit, what you're paying into the position, long call minus short call premium, is less than the difference in strikes. I see a lot of people who build diagonal spreads. I might take Etsy, buy the 25 call instead of the 22.5, and sell the 35 call. And so they have a 10-point difference in strike prices, but they're paying a debit of $11. That wouldn't happen with Etsy, but let's say they did. Why is that a risk? Remember, you don't own the stock. Okay, you own the right to buy shares of stock. You've entered an obligation to deliver shares of stock that you don't own by the short call. Now, it probably wouldn't happen in this case, but I've seen it happen to many investors. Let's say, I'm going to take Apple for an example. We're going to switch modes here and get a more reasonable spread. Just going to take a look at the Apple prices. I'm going to go, we'll stick with the 28 days out for you, John. I'm going to go to 2019, and we're going to go 150 call. Might not be the one I select. I do have criteria I look for delta for the long option and what I call the delta ratio. I want a certain ratio as well. Let's give us some breath. 175, 150, 175, a 25-point spread. Okay, oops. I put that in twice, I'm sorry. So we're going to buy one and sell one. There we go. Okay, so the net debit is 22. And my difference in strike price is 25. That's good. All right, so it's 22.24 is the net debit, $25 difference in strike prices. Why is that important to me? Well, if something good happens with Apple, and out of nowhere next week, on Tuesday morning or Wednesday morning, it gaps up to 185 before May expiration, I have an obligation to deliver shares of stock that I don't own. Okay, that's fine. That's why you bought the call. It's supposed to cover it. Or the 150 call, here we are, the 150 call, it's supposed to cover it. What your broker should do is, if you're assigned early, they will exercise the long, essentially buy 100 shares of stock for you at 150 and immediately sell them at 175. You get the debit back at 25, so you make about a $2.75 profit. It's pretty good. Oh, it's 275. Where am I seeing the 794? Because if the stock is trading at 175 or 185 on May expiration, this still has 7 months of time value remaining plus the $35 of intrinsic value. I want to do everything in my power to be able to sell to close this option if I'm forced out of the trade, so I take that time value back. If I just exercise it, I'm cutting the return down drastically. Okay? But that's the safety. That being said, 3 months ago, right before New Year's, I believe, in December, we had a discussion with a gentleman during one of these sessions. Had something interesting happen to him. He was in a diagonal spread such as this. Stock gapped up to 185. He got assigned early. He got a double whammy. He got assigned that Friday. Okay, it was a week before expiration. So he got early assignment on his call, so now he was short shares of stock. Part of this was because something he didn't pay attention to and probably should have, but it was a double whammy. It gapped up. It was the Thursday before. The Thursday before the Friday, a week away from expiration. I know it's confusing. It gapped up. He got assigned. Because Friday, the day following the gap up, which was still 7 days to expiration for him, was ex-dividend date. So he woke up to being short stock, had to pay the dividend. Right? Because when you're short stock, you have to pay the dividend. And his broker did not exercise the long to deliver the short because they said, well, they weren't linked together because this one's further out in time. Yes, if it was a call debit spread and they had the same expiration, we would have exercised it, but we didn't want to take the time value away from it, so we didn't exercise that. Instead, we allowed you to be short stock and pay the dividend, which, pardon my French, screwed him even more. Okay? That's something you want to make sure you clear up with your broker, that they will exercise the long to deliver the short and early expiration, early assignment. And the reason why I'm bringing this up, if I accidentally found a position that I said, hey, these strikes look really good. I like it at 175. I like it at 150. But on Apple, if this was actually 26.50 and I was only getting 98 cents, now my debit's 25.52. Still looks like a good return, but if it gaps and I'm assigned early and my broker exercises the long to deliver the short, I only get 25 points back. I missed the time value that was still holding on the LEAP option, which means I'm locked into a loss. It's a gain if the stock's trading here and I sell to close the long at the expected value and the short expires. That's the max return. But if you exercise the long to deliver the short, you may actually be at a loss if you don't pay attention to that debit strike difference ratio. Okay? Is this the right market for them? I'm not sure. The way things have been moving recently, the way things have been adjusting and what we saw there, I don't know if this is the best time frame for these diagonals, which is why I haven't opened them. Okay? And RB on this topic, RB says, how would you play a super volatile stock like AAOI? A diagonal call would be a better play, or do not trade. In general, RB, I will not trade. I'll stay away from it and look for positions I'm more comfortable on. And we'll take a look at AAOI. I know it's been very moving about very quickly in that situation. We'll take a look at AOI just a minute, RB, there while we're talking about this. I think a better play might be to use a double diagonal, similar to an iron condor, as volatile as it is, but you have those outside wings that are further expiration, but you can't get yourself into trouble in the short one. So a double diagonal to hedge sort of both sides might be good. Question that comes in, okay, all the time, and I have webinars that show this, and I'm going to follow up with this from the webinar we did a couple weeks ago. Everyone says, well, to make it better, let's go back to our normal position. Okay, normal. Let's go back to the original position. I'm just going to add it back in. Our 150 January call on the position and selling the 175 near term. And everyone says the next thing, well, what about buying a protective put? What about treating it almost like a married put position with the calendar spread so that you don't have to worry about the downside and the leverage risk? Number one, it's very risky to add a protective put similar to a married put in this instance, and I'll get to that in just a moment. But you already have the short call sold, which means if you buy an out-of-the-money put 1 or 2 months out from May, or let's go ahead and do that, you actually create now a different structure entirely. Okay, so let's go to May. We collected about 218 for this call that we sold, a little bit more, about 218 for that short call, the 175. So I'm going to take half of that. I'm going to buy the 150 put at 140. So now I'm lowering the premium naturally, the cost of insurance. Okay, but I still have a short call. And so you take away this, but now you can do this. But here's the trick. Everyone says, well, this way you can have extreme wins down here. You're not risking as much right here. Yeah, you are. You're still risking 2368. Oh, I'm sorry, 1076, so 45% of what you invested. Okay? And you can still make a decent profit here. Well, not really. It's half now of what you expected to make. And then if it moves up here, you'd still be rolling the call and so forth. So the advantage of this, saying that, oh, but it's such a high return if it falls, you are not expecting the stock to go to 125 or 100 where that would really pay off anyway. If you did, you'd be doing an entirely different strategy. This kind of comes down to that discussion. Let's say I'm doing credit spreads, and I do spreads that have an 11% return on average on investment, whether it's 1 strikes, 2 strikes, or whatever, and I have an 80%. I'm looking for those with 80% probability, okay? And what I really need, and we've talked about this many times, but what I really need here is to be right 85 to 86% of the time to profit long term, because this 11% will probably give me an 8 or 9 to 1 risk-reward ratio. One loss is going to wipe out 9 trades, so I need to be right closer to 85% of the time to profit long term. But a lot of investors say, well, you took in a credit of 50 cents on a 5-point spread. That's your 11% return. So in this case, you could do better with the probability and success rate if you closed this out when you received a 50% profit. So if you can close all these positions out for only a 25-cent gain and make 50% of what you expected, you might push your success ratio up to 91% or maybe even 95%. But now my return is only 5%. It's not 11. So now, with still risking $4.75 per trade and making 25 cents, I actually need this to be at 95 or 96%. It's an 11 to 1 risk reward or 10 to 1 risk reward ratio. I need to be right in that 94, 95% range. And there's no guarantee that closing these early is going to balance it out. Why is that pertinent to this discussion? Is because remember, if you're building a portfolio to use diagonal spreads, any spread, you're basing it on, I want a leverage return of maybe 12, 14, 15% or higher. I know that not all my stocks are going to go to that high range, but I'm going to plan on selling it month by month, just like you would on a covered call position. Unless you do get assigned, you get the target you want and you close out of the position. But once you buy the put, you're not going to have any extreme losses, perhaps, of that 35 or 40% of what you invested, but you're only going to have 5 or 6% gains per month instead of 12 to 15 or 11. Everything works in balance. Does that meet your goals now if your max return and what you're getting is limited to only 5% where you wanted 12? Don't get me wrong, I'm not saying you shouldn't insure the position, but remember, in this case, because you're using 3 leveraged vehicles, you've hedged the loss on the position, but you still could see a 45.6% loss if the stock craters down there, and then you'd have to sell the lower strike calls to get back the premium you want, right? But it changes the dynamic of the spread, and it's going to change the win-loss ratio that you need to be successful. But, you know, we talked about it before. What would a 10% decrease here? Let's just call it 16 points down to 149. Yeah. Say that happens. Okay, so even with the put in place, the put's going to give us a gain of $159. Remember, we bought the 150 put. The stock's just below there because it's shorter term. So it might go up to $3 before expiration. We're still losing $1,100 on that leap call. Okay, and the investment total was $23.62. So here we are at $806. Still at that 23, 24%, 30%, aren't we? Okay, so that's the key to watch out for. Now, I'm going to do this first. Clear this all out. Many of you know, of course, I'm an advocate of the radioactive trade married put. I've got a question. A gentleman who's been waiting patiently here, Jeffrey, he asked a question on that as well. He said, I'm trying to grasp the married put concept. I have a few positions open, and I only see all of the positive moves on the stock be diluted by the long put. How is the best way to view this mentally and manage this position? Jeffrey, number one, that's what the blueprint's for. The blueprint is the full work where we discuss the radioactive trading techniques and when to use them and how to do them as well. But let me talk about a married put here. I'm sorry. I'd likely buy, if I opened a married put on Apple today, I'd probably buy the 175 put and buy the stock. By the way, I can't because it's outside of my price range. This might be a calendar spread for me. Okay? All right. So here's a position. A married put I would open, 5.2% risk, really in the range I like for 8-month, 9-month out trade. Yeah, 9-month out trade, excuse me. But it costs $184,000, $18,460, I'm sorry, to do 100 shares in one put. Okay? And, of course, my risk is $962. Now, I'm going to get to you in just a minute, Jeffrey, but we're going to take a look at this here as well. Now, a lot of investors that I show, when we first show the radioactive trading techniques to, will say, well, number one, why don't you do this? Buying a call is much better. Well, we showed that. Okay? And I'm sorry, I had a webinar on that where we compared why the long call is not a parity trade to the married put. You can check that out on the webinars page and also on YouTube. And it's because of the lie of leverage. We took actual trades. If I'd opened the married puts, I would have opened 2 every 14 days from the beginning of January to March. And I did the same quote-unquote parity long call. The long calls would have been, long call portfolio was at a loss because you would have closed positions if they had a 30, 40, or 50% decline, which they did with those 2 shifts in February and March. Meanwhile, my married puts were only losing 4, 5, or 6%. But they're not parity trades because calls have the lie of leverage. Those 10% stock drops resulted in a 35, 40% drop on the positions. This married put, if it dropped 10%, Apple drops 10% in the first 15 days, I'm only looking at a 2 or 3% loss in this position, not even the full loss of 5.2. I can stomach that, readjust, and move forward. But before we get to Jeffrey real quick, a lot of investors, just like some were leaning to with their question, buy a protective put at the diagonal spread, say, well, why not just, if this was the put you're going to buy, why not just buy that 150 call in that 150 put? Isn't this a better use of money for you? And the answer is no, because it's still a leveraged trade. Yes, I only have 4,000 invested instead of 18,000. I have 2 ways I can win. if, that's at expiration, so that doesn't count. You have two ways to win, but at expiration, it's not until the stock hits 130 or it goes up to close to 195. And I'm risking 1,800, twice the amount I'm risking on the married put. Okay, is that a fair comparison? It is, because what I'm saying is the worst case scenario on the married put, if I held it all the way to expiration, did nothing, and Apple was below 175, or even in this range here, the worst case scenario for the married put or lower, the worst case is $960. Here, the worst case is if it's trading at 150 to 175, you make no adjustments. It's twice the risk, or 42% of what you invested. If you take a 42% loss, you need almost a 67, 68% gain on your next trade to get back to break even of what you invested. Okay, so that's sort of the trade-off there with these strategies. Is it two ways to win? Yes. If the stock fell down to 120 or 100, the married put would be at a loss. This would be at a gain. Okay. What if it falls 5% in the first 30 days? Wouldn't this be better? Well, no, you have less money invested, but in normal market conditions, you're delta opposed here, not delta neutral. Okay, which tries to substitute a long call in the married put trade and have an in-the-money long call in the put, you're delta opposed, meaning the stock needs to move more in the first 10, 15, 20 days before you start seeing a profit. So let's take a look. Let me just go up to 171. And we'll go standard May 18th expiration. Now, that's not even a big move, but let's go to 171. Yep, still at a loss of 850, almost break even on the strangle. It's not showing a profit yet as a 6-point move because you're delta opposed. Meanwhile, that $5 or $6 increase on the stock to 171, I'd have a $2 or $3 profit on the married put because it is more directional to the bullish side. If the stock fell 5 or 6 points down to, let's say, 160, I'm losing 206 here, but I might only be losing $1.50, $1.20 on the married put. Normal market conditions, you see lower losses to the downside and faster gains to the upside, meaning 3 to 5% gains on a stock price in that time period. You're right. If this jumps up 25%, this in-the-money strangle is going to be more profitable. If it gaps down 15 to 20%, this is going to be much more profitable than the married put. But when I looked for married put, I'm not looking for a stock that I expect to move 15 to 20%. It's not a volatile position. It's a position I've looked for that is neutral to bullish, and I feel has the potential to move up 3 to 5%. Although capital intensive, the married put will perform better than the in-the-money long strangle. But back to Jeffrey's main question here about the stock doing nothing, okay, and the stock not moving per se and losing value on it. It's been a tough market, okay? Let's go back here to, oh, sorry, I still had it open here. In the past 2 to 3 months, it has been a tough market since February for married puts. I could have made a killing on AMAT, which is a married put I just closed today. I let it get exercised to close out of the position. This is an AMAT, of course, but this is sort of a tough time. But that's what the income methods are for. Let me go to AMAT actually, and then I'll take a look at AAOI for everyone. And I don't have the quote directly, but I have another customer, Jeffrey, that I talked to recently. I'm sorry, I want to go to AMAT. My apologies. Another customer who wrote in this week saying he finally gets it. Okay, he saw some of these movements he had on his stocks as well over the last couple of months, where he got in here, had this happen, but he's noticed, wait a minute, on my 300 shares, my stock's down 3% or close to $1,400, but the married put itself right now, I'm only losing 300. Okay, so here might be a panic mark for what he invested, but he's saying, no, I get it now, and it moves back up, and he's at a profit here. Even though he has the put, he's at a profit in this position. Not what he expected. Right? He's maybe at a 1%, 2% profit, but he's still seeing some gains. And then this happens again. And then it comes back up. And at this point, he's saying, you know what? The stock's almost right where I was trading at before. I'm at a loss now at 0.3% or 0.5%, let's say, of what his maximum risk was, the $1,400. He's only noticed a 0.5%. But then again, he also went through 60 days of time decay almost. Okay? So this is not the best market, but there are things that you could do here to catch this. You know, if you saw it, as we talked about, when I saw this crossover, I might have waited for the bottoming or the new crossover, and I could adjust the put here to lower the cost basis on my position. Then when it came back here, I'd be at a higher profit. And oops, if I see him move again, I probably wouldn't do it there, but I could do something else, income method number 12 perhaps, get a few dollars of profit out of it, and then when I see it bottom and switch over again, or then here, probably wouldn't have done anything. But I know this has not been the best market. I've opened 2 positions recently for Fusion subscribers. The one I opened this week, I think it's down $1.40 on a $30 stock since the day I got in. I don't have it listed on my webinar account. I should have put it in. I didn't. It was on PHM, bought the stock at 30.01, and then I bought a October, perhaps. Let me just take a look here. It's 28.54, so it's down $1.50, which is a decent percentage. Yeah, I'm pretty sure I'm at October, and I bought the 31 put is where I'm at now. So the put has gained 65 cents, and I'm down $1.40, $1.50. Another thing that you probably came into contact with in the last 2 months, Jeffrey, with the put options that you bought, it's not your fault. There's nothing against it. Again, from our previous discussion earlier, it's just based on market conditions. If you bought puts here when you thought things were recovering, you entered married puts here, or maybe even here, the implied volatility of the puts, even 6 to 8 to 10 months out, was probably higher. We probably saw a relaxing of implied volatility in the last 40, 35, and 25 days. So you might be suffering a little bit of implied volatility crush, not a lot because they're farther out options, but seeing that as well. Okay. So, but then again, I have customers this week who got themselves into trouble in other strategies because they overtraded. Covered call here, the stock fell, and they said, oh, I don't like this. So they rolled down, they bought the stock maybe at 55, sold the 52.5, and it fell down to 48. They said, oh, I'm losing too much money. Let me buy to close the 52.5 and sell the 50 because I got to get the premium. And then it snaps back up. Well, now they got to buy this back. They made a profit here, got another premium here, but now they have to buy this back and roll up to, say, the 55 or the 57.5. And then they had to buy it back again at a higher price. So the stock has moved up from where they got in the covered call, but they're losing money because they're overreacting to all these movements. Although you've been sitting on these positions, Jeffrey, for maybe 2 months or 3 months and you haven't seen the movement you've expected, you're seeing the put diluting from some of the gains in the stock, maybe from a volatility crush. Well, this is a good reason to be in the married puts in this kind of market because we don't know what's coming next. I'm glad I was in the married put here for longer term because I could withstand all of this and could have done adjustments here, but if I overtraded it, which I almost did, I would have actually been at a loss of 4% when I closed the position today instead of a loss of only 0.2. Okay, and if I may still get a next dividend because I did cross the next dividend date, it just hasn't paid yet, so that'll actually be lower and might actually be at break even. Not a great return, but I bought the stock at 58 and it closed today at 51.90. Okay, so it's a $7.50 drop over a 4-month period, 5-month period. I'm only losing 0.2%. It might actually be break even. Okay, all right. So Sam, I didn't see Sam chime in, but everyone had asked me a little while ago. Oh, Jeffrey, I apologize. What I'm going to encourage you to do is email me some of the specifics of the recent 2 or 3 of the recent trades you have. You can send it to support@powerop.com. Tell me what your original purchase date was, what your purchase price was for the stock, expiration date and strike of the put, and what you paid for the put. We'll take a look at the chart here, and we'll say, well, here's some of the things we might have done and might not have done. AAOI, Applied Optoelectronics. Yeah, I've seen this one come up in the naked put search, the weekly naked put search. The trend is looking really strong as far as the technicals go, but it bounces around a lot. And you're asking, what is the play to do here? Well, it's anything that won't cost you too much money, but will allow you to take advantage of profits in the case of gaps down, strong movements up, down, and strong movements up. And it's probably expensive, and it might not be worth it, But I don't know, you'd have to pick the right strikes. It'd be all the way out to maybe 35, but we've seen it gap more than that, so you might have to go to 40. Selling a 40 call out of the money for the diagonal spread and buying, let's say, at 27.5 or something along those lines. If you set a 36 or 37, it might blow through that in the next couple days. And then on the put side, you may have to go as low as 25. So everyone says, well, where's the safety lines here if I wanted to do a short straddle or a short strangle? Well, where hasn't the stock been yet? Well, it did go below 25. You might be selling this, a 25 put, and going up as high as maybe 38 or even a 40 straight call that's out of the money, and of course buying the outer wings for the double diagonal, which are further out in time. These options will gain with these spikes up and down, but is that enough? Is going here and here with your short options enough? Probably not. You might be better off doing something along the lines of a strangle, which will be expensive, which is what Sam usually does, but then he looks for opportunities where it's sort of settles down and maybe sell a call here, but when he sees it start to reverse, buy back that call and maybe sell a put. Okay, and sort of legging in one direction or the other, but having the base of a 2-month or 4-week, 5-week, 6-week out strangle, long call and long put, and then rolling these occasionally. That's not how I like to trade because it requires watching the position. If you're kind of asking me what is the best position and the best way to trade AAOI that has all this movements where you don't have to watch it, I'd say move on to another trade because you're going to have to watch it. If you want to sell premium because of the volatility, you're going to have to watch these movements because anytime you sell premium, it's going to be directional. You might want to look at sort of ratio backspread positions or broken wing butterflies. They still come with risk and wild swings as well because anytime you sell premium, you're picking a direction. And if you sell calls and puts, you're still picking a neutral direction. You're going to have wide bid-ask spreads because of the volatility. But if you want to put on a position that can profit on AAOI where you don't want to have to watch it that much, I'm going to say don't because you're going to have to watch it a lot. Okay? You're going to have to watch it frequently. All right. RB says, another question on Ford. I bought it for a dividend. The share is down more than the dividend amount. Okay, should I create an arbitrage position before dividend to avoid more loss, like selling deep in the money call day before dividend? No, you can't do that. You'll avoid the loss, but if you sell an in the money call for that expiration before the ex-dividend date, you're going to get assigned. You're going to get early assignment most likely, so you'll be out of the position and won't get the dividend. And by going deep in the money and in that fashion, you're probably not going to get a good return on a position like that. The best thing to do, you may be probably hedging it by, so if you own the stock, you may want to hedge it by selling out of the money calls to hedge the loss a little bit. All right, not in the money. You probably want to be looking at out of the money calls to get a little dividend-like income on a monthly basis, hoping the stock doesn't breach it and you get assigned. But it'll give you some premium cushion to counter what you'd expect with a dividend fall. Okay? Oh, I'm sorry. Ben says, so the best strategy is still married put and covered call to reduce the put cost. Well, there's other things that you can do on that position. In addition to that, the different income methods, Ben, where we can do a spread that generates income but still leaves the upside open and doesn't add to the risk in that married put combination. Standard collars are still good. I'm a fan, as I mentioned, of diagonal spreads, the poor man's covered call that we looked at. There's nothing wrong with adding a put option, not this way. I don't advise the in the money long strangles unless you have a longer term trading plan that you're going to do with that. But I'm a fan of the idea of adding protection to the poor man's covered call diagonal spread. But remember, it changes the dynamic of the entire position. Okay? It does change that together. Ben says, what about the married put with a ratio back spread? Not something that we do because it changes the profit level of the position. The ratio back spread sort of gives you a double glitch hedge on it to the top. So you're taking away from the profits at the upside by doing that until it really takes over on both legs. I don't do we do the standard ratio call spread, which doesn't add risk in the married put. Okay, because you already own 100, you already own shares of stock. So selling 2 to 1 means you have shares of stock to cover one short call, and you're buying the call to protect the other. It's like a stock repair. A stock repair is a ratio call spread, but it doesn't add to the risk because you only own the shares. Okay. Oh, Sam says, he said, buy a 49 call and sell at 52, sell a 52 call, and then buy puts again to protect the stock. Same trade in MU that's been moving around. Yeah, buying puts and selling them at the high, and buying puts and then at high and then selling them out. Yeah, and Sam, you're right. I could have done that with AMAT position we looked at, maybe even with AAOI, but I'm out of the position now. I didn't want to overtrade the AMAT married put. I didn't. I undertraded it, I'll admit, but I'm out of it now, and I'm not going to continue to play that. But I won't do AMAT as a calendar spread, I'll tell you that. I can't give trading advice really, but I'm not going to do AMAT as a calendar spread. But like you mentioned, maybe buying 3 to 4 months out, or I'm sorry, 2 months out or so on that 2 or so months out calls and puts there as well. On AMAT, and doing the strangled 1 month, 2 months out in time or so, and then selling weeklies against it and going back and forth would probably be a better play than trying to force a directional diagonal call, diagonal put spread, or even, I don't think I want to trade a double diagonal, which looks similar to an iron condor on AMAT right now, because it could swing one direction or the other very quickly, and that's not the strategy you want to be in. Now, John asked a follow-up question. This was related to the diagonal spread, of course, that we were looking at before. And he says, what if the short call is overtaken? What happens to the position? We kind of touched on that. What could happen, the risk that would happen, and that you would have to do it. Think about it this way. You mentioned that there are many out there, and I don't even know when Apple's earnings are, so I wouldn't suggest doing a diagonal spread through earnings. In fact, I never have a short call open, whether it's on a diagonal spread, a married put, or a collar going through earnings. I want to leave that upside open. I might miss out if the stock drops, but I want to leave the upside open in case it gaps up. But in any case, what happens, John says, in the diagonal when the short, it goes above the short, or the short is threatened? See, the difference here, I don't know who's teaching it this way. Okay, that there's a couple services, I think 5 or 6, that use the term poor man's covered call. I just call it what it is, it's diagonal call spread. However, that being said, I don't know what their goal is. When the stock starts going further and further up, you lose profit. Why? Because now the delta of the short option is getting closer to 1, right? What happens at expiration? May expiration. The delta of this short call is either going to be 1 or 0, right? Why is that a problem? Well, as it gets in the money, this actually gets to 1 faster than the LEAP option. The stock's at 185, May 17th. Your delta on your short call might be at 0.99. This might only be at 0.85. Might be at 0.9, but again, this is why it tails off, because the buyback cost of the short call is equal to intrinsic value. Okay, so as it moves up above there, the best case scenario is that it ends right here, but as it goes further up, you're paying more naturally to buy back the call to roll it. So what do you want to have happen? That's what I don't know. I know what I want to have happen with my diagonal spreads. That's how I approach it. I don't know if where you're learning this poor man's covered call, if they're teaching it as you want to be assigned, so you don't care if it goes up to 200, 225, or 230, because you want to be assigned, exercise the long to deliver the short and get the $25 back, not the full profit. I always want to sell to close this personally to take advantage of it. I want to avoid being assigned if possible. So I treat this just as I treat the income method number 1 in the married put, selling a call, or if I'm in a core stock holding of my account, selling out of the money calls on it, like the forward example we discussed there, so trying to collect a monthly or bi-monthly dividend-like income to enhance the core holding, but I don't want to get assigned. So as the stock gets within 1 to 0.5% of my short call strike price, I'm going to take action. What could that be? The exact same thing I do in a covered call that I didn't want to be assigned. I could roll it up and out. I could just buy to close it if I had enough time decay and leave the upside open. I could close it and maybe open the ratio there to do sort of a stock repair. That's what I do with my diagonals. by the way, because I'm not looking to be assigned. I don't want to be assigned. If anything, I want the opportunity to be able to sell to close the long option to make sure I take the time value. I don't want to risk holding this to expiration and say, oh, it's 2 points above. They're going to call me out at buy me at 150 and sell it at 175. I'm good with the return of $3 or so off the $22 investment per contract. It's a decent return. But I missed out on close to $3 to $4 of time premium that still exists in that call. 3 to 4 above that value. Okay, so you treat it almost like that. Yeah, and that's what I'd look for with managing the diagonal spreads also. Okay. All right, I'm just going through something here. See if there's any conversation here. By rolling up and out a month, okay, this was from Mark. By rolling up and out a month, you desire to get an additional credit while avoiding having the sold call exercise. That's right. So normally what I said is I usually am going 3 to 4 months out with my LEAP and selling 14 days out in time. So this is 120 days max. Oh, this mouse is, sorry. 120 days out, let's say, on my LEAP, and I'm selling 14 to 20 days out there. So that gives me about 6 to 7 what we call write cycles, meaning I can write that short call maybe 6 to 7 times every 14 days or so against my LEAP, which is 110, 120 days out. And I want to make sure that I at least try for half of that. Now, sure, I might just see an example where it goes up, it expires right here, I sell the second one, and it expires right at the new strike price I sell, and I've made a really good profit. I might just get out early. I have goals, just like I have with the married puts. I have monthly goals I want to make for premium or for lowering the risk. So, you know, when you look at a position, you know the number of write cycles you have initially. You know, I usually end up getting about half of them before closing a position for gain or deciding I need to adjust the position a different way. But you're absolutely right. I'm looking to sell 2 to 3 cycles, and in my case every 14 days. The original question that was asked for the poor man's covered call about buying the LEAP and selling 1 or 2 months out against it, well, here we are, January, 7 months away roughly. I'm saying 7, it's 9 months away roughly, and I'm selling 1 month away. So I probably want to try to write this for May, June, July, and then August or September. I'm going to decide if I made the money I wanted to, or am I concerned if I haven't already closed the position by that time. But yeah, just like a covered call, you're rolling it up and out, trying to roll for a credit because you want to cut down the cost basis of this, which will increase the returns each time you do it. But it also depends if the stock gaps up quickly. If it's too much to buy back this call, I may just take that first cycle 15, 20, 25 return there. Harvey, no. Harvey, if you've got the stomach for it, more power to you. I wouldn't do it. Harvey just kind of a comment. It's not a fair thing to say to Harvey that way. He says, what about an iron butterfly in this market? I don't trade iron butterflies ever to begin with. This type of market especially. We talked earlier about the implied volatility. With some of the stocks moving, AAOI, things of that nature, and the high premiums, does it make sense to do an iron butterfly? I don't think so, because there's still uncertainty about swinging either direction. And this is a very neutral position. And even though, now let's take AAOI. I mean, I'm not going to make a trade recommendation here, but let's take AAOI, for example. What is an iron butterfly? Similar to an iron condor, but, whew, buddy, look at those premiums. So, I was at 30. So we'll do 30, 35, 30, 25. It's similar to an iron condor, but the 2 strikes you're selling are at the exact same price. So rather than going out of the money with a bull put credit spread or bear call credit spread, the iron butterfly, you're getting a high premium by selling right at the money for your 10th profit and loss chart. Now, this looks profitable on this, and I know AAOI is an extreme example, Harvey, because of the swings we saw when we looked at the chart again. It has been below 26 within the past 2 weeks, and it's been above 33 in the past month. 2 months, I believe, wasn't it? Let me take a look here. Yeah. Okay, so it's right at that cusp there. Oh, not 30. I meant it swings in this direction. It's been as high as 35 in the past 2 months. That's what I meant to say, Harvey. It's been as low as 25. So even if you swung the legs out wider on this, is it a good profit? Yeah, it's 389, a 352% based on the margin requirement. It's just a bull put and a bear call at the same strike price. But again, we've seen the stock breach the lower break even. We've seen the stock break the upper break even, and it moves too much. I don't like it. And a customer asked me about a broken wing butterfly, which is similar, but the second leg is further out of the money in this situation. And I wasn't fond of that either. He says, what about a stable stock like IBM? And then we saw what IBM did. Most of the time it's stable. That's the double-edged sword, isn't it, Harvey? We like this because we have higher implied volatility right now. It's still hanging out. It's been dropping, but it's still hanging out with high IVs. We can find positions with high IVs. We're seeing market fluctuations. I don't want to be fluctuating with this. I need a market that's stagnant and stable, which means it would be lower IV and lower premium. Remember what I said at the beginning of the presentation. It doesn't matter to me how much premium you receive up front. Okay, if you don't pick the direction of the stock that matches the strategy, it doesn't matter what your IVs are, you're going to have a problem. Another reason why I'm hesitant on iron butterflies. Step back one, Harvey. I'm not the best person to ask about this this strategy. I never trade this strategy. Okay, why? If you trade this strategy, I'm not saying it's a bad strategy. I'm not saying you're not going to be profitable long term in this position if you pick the right stocks. What I'm saying is that I can't pick a strike price. And what I really want to say is if I enter this position, it's because I feel confident that AAOI is not going to be more than plus or minus a little bit under 1% from $30. Okay, it's going to be plus or minus 1% from the peak in the next 28 days to May expiration. Did I select May? Yeah, May expiration. I can't do that. I honestly can't. And if you can do that on a consistent basis, I love having you here, but you don't need to be here. There's nothing I can teach you. If you can consistently pick stocks that are trading plus or minus 1% of a strike price in a 20, 30, or even 15-day period, I'm not going to be able to help you with too much other than evaluating the risk on the positions you're taking because I can't do this. I don't touch this strategy with a 10-foot pole. Iron Condor would give you wider legs, sure, but it's still an 8-to-1, 9-to-1 risk-reward ratio, and it could still come back to haunt you also. The market to me right now is hesitant, and it feels like it wants to go one way or the other, but it hasn't proven to me which direction it's going. So I'm very hesitant to open bull put spreads or bear call spreads. Iron Condors or Iron Butterflies, I'm playing it safer. Then again, if you have the stomach for this, if these numbers look good to you, knowing where it has been and what's coming up with AAOI, it's got to be some phase 2 or phase 3 drug trial or something that's coming up in that short term, that near term to May expiration, but you're comfortable with the range that you've selected, then that's okay. Okay, but I don't think this is a good one here. Mark admits that TLT has treated me well with iron butterflies and iron condors. The Treasury ETF, not maybe a larger stock, a volatile stock such as AAOI, of course. And that's the key. Was TLT the double or is that the single? I always forget. Sorry, Mark. TLT. All right. But anyway, okay, it's the single. Things like this, Treasury ETF. Mark's been doing good with iron butterflies. See, but now what are we talking about? We're talking about volatility in the 10, the 9. When I trade iron condors, I prefer to trade them on the broad-based ETFs and indexes. I don't trade them on standard stocks. Broken wing butterflies, similar. If I ever traded an iron butterfly, it would be on something like this. I don't want the higher implied volatility because then I'm going to skew my entire win-loss ratio in that direction. Okay, because I'm going to take more losses because the volatility is too high and it swings too much against you. Okay, and so in this market, most stocks, normal stocks, things of that nature, I don't think they're the key. I don't think an iron butterfly right now is good on those positions with the market fluctuating the way it has been as well. There, okay. Ben says, can you explain buying deep in the money call spread at delta 65? What I assume that means, Ben, is a bull call debit spread from your description, I think is what you're asking me. Sorry, let's go to custom spreads. And I don't have it here, but what you're looking for is you'd want to buy, sell in 65. Okay, so I see what you're doing. Okay, it's not an in-the-money debit spread. Buying deep in the money call spread. Oh, you're saying it is a deep in the money. The long option might have a delta. See, what I'm having a problem is, let's go to the chain. I should have just gone there first. Let's just look at a call chain for Apple. Okay, so what I'm confused, your question said buying deep in the money call spread at delta 65. All right, there's my deltas. Let me go to May 4th, 2 weeks out. Much better. Okay, so what you're kind of asking me is what combination here, when you'd be selling the higher and buying the lower, I think you want the combination to be 65. That's tough, because what it really means is you might be buying here at 93, but you're selling out of the money at 31. All right, so that gives you sort of a delta of 62, okay, under the 65. So I'm not sure if you mean buying a delta near 65 and selling the short, but if you're selling a debit spread, of course, selling one and buying one. And if you're talking about buying a spread, that implies to me a debit spread. And if you want a delta of 65 between the two, you're looking at a combination here, the delta between the two. So it would be the 172.5 compared to the 162.5, and then we'd have the 170 paired with the 155. Yikes. That's a big one too. But that would be it. Or you could do the 87 there. So I'm not sure if you're talking about the ratio between the two, but it sounds like if you're talking about the ratio, it means you're buying one that's in the money and selling out of the money. So you have a 0.3 or 0.2 delta combined with a 0.8 or 5 or a 0.95 delta to get a combined delta of 0.65. If you're doing an out of the money, even though the long option you're buying for the bull call debit spread is in the money, the one you're selling is out of the money. If you're going to sell out of the money bull call debit spreads, buy out of the money bull call debit spreads where the stock is between the strike, make sure you're going at least 1 month out or maybe 2, because you need the stock to move up to this price in order to make the full profit. You can have a good profit if the stock just moves up a little bit, but that's why most investors will do the in the money bull spread, so you have the higher probability of it staying above 162 or 160 and getting the full profit, though it's less. Okay? Doing the out of the money spreads, where if I sold, say, the 170 and bought the 160, that would, yeah, so you can see it here. This would cost me about $5.50 to enter. I'd have the delta of about 0.48 in this one, delta ratio between the two of 0.48, but it's a 10-point spread. So I'm looking at almost a 2-to-1 reward to risk ratio, not risk to reward, right? Because it'd be a $5 debit and I run the risk of getting 10 back. I'm looking for to get 10 back if it goes above there. So it's almost a 2-to-1 reward to risk ratio in that case. So yeah, I'm not sure, Ben, in that case, if that's what you're looking for. The advantage of selling the out of the money is you get higher gain on that position. Ben said you meant buy the 160 and sell the 162. Okay, if I went to weeklies, you buy the in the monies at 160 and 162 in this case. Okay, so it's a debit spread, right? And we'll go 2 weeks out here. 14th again. Oh, okay, so yeah, let's do the 160. This would be the bull call debit. It's going to look pretty good. Okay, we want the stock to stay above 162. So what happens? You paid 170 for this spread. It's a 2.5-point spread. If the stock's trading above 162.5 on May 4th expiration, what happens? Well, if you don't close it beforehand, you have to deliver 100 shares of stock, or how many shares of stock at 162.50. So your broker buys at 160, sells at 162. You're out of the position you paid 170 in. You get 250 back from buying at 160 and selling at 162.5. So the max profit is $80 off of 170, or 47.1%. Okay? Exact same risk-reward profile, of a out-of-the-money bull put credit spread. So if I sold the 162.50 and bought the 160 put, $52.3% return, because you'd get an 86 cent net credit off of a risk of 164 that you'd have to put up to make the trade. As long as the stock stays above 162, both puts expire worthless, you keep the net credit. Okay. All right, so yeah, those are parity trades of those two. The bull put credit spread and the bull call debit spread, remember, they're parity trades of one another. You always want to take a look. And we have that available for you in what we call the spread chain, which I can access from the signature tools or from the bull put credit or bear call. And what you can see here is for any expiration, you can look one stock at a time. But you can see the call debit and put debit parity, call credit and put debit parity trades to see which one has the best bang for the buck. What do I mean by that? Let's take Apple again. In this scenario, we'll go to May 4th, and I'll say I want a 250 spread. Credit doesn't matter, but let's go ahead and put in 25 cents. Out of the money range, not that, minimum return, 2%, whatever, but I want a probability of greater than 75. Okay, and let's go to May 4th, 14 days away. Oh, sorry, should have been there. I apologize, folks. Let's try that again real quick. 25 to 75 to 90, just for example. Let's try that again. Okay, so here we go. Here's my two spreads. That's too low. Did I have the return set too high or the probability? Probability wasn't that high, I guess, for the 165. Let's drop it down to 70 again. Let's take a look here. Oh, there we go. Okay. All right, so anyway, on my right is the bull put. So these are further out than we'd probably want. Man, not a good return in any case. And they're even. Oh, sorry, the bull put is equal. Let's change this up a little bit so we can see better comparison very quickly. 65. Return of 5 for May 4th. All right. Any discrepancies? No, these are evenly priced. It's ridiculous. Sometimes you'll see discrepancies where, see, here's that 162.5, 160. The bull call debit at midpoint, it cost you $8.70 to buy the 167 for the 162.5, a debit of 170, but you would get the 250 back. So, oh, sorry, the return is 47.1%. Okay, remember, we'd make 80 cents off of the 170. But the return on the credit spread at midpoint, you see there that the credit we'd get for the bull puts is a parity trade, same strike, same risk reward, same probability, 66.2%, which isn't that great, but we get an 85-cent net credit, 5 cents higher up front than the max return I could get on the debit spread, and it's 51.5. So in this scenario, before I open a debit spread, I'm going to compare it to the credit spread, which has the same probability, similar risk reward profile, but if I see a discrepancy, I'm going with the credit spread as opposed to the debit. If I wanted this 77% range, if I get midpoint, I might make 40% on the call spread and 36% on the put. So here, with these strikes, if I really wanted the 160, 157.5 for that 75% probability or higher, I'm going with the debit spread. If I get filled at midpoint prices, which is sometimes higher within the money calls because it's a wider bid-ask spread because they're deeper in the money. Okay, but I'll always compare it in that situation. So whenever you're thinking about a credit spread, always compare it to a debit. They are parity trades of one another for the same expiration based on midpoint prices. If you get the midpoint, one might give you more bang for the buck. And remember, if things work out the way that you want, if I did the bull put credit spread and the stock stays above both strike prices bin, I don't have to do anything. Both puts expire worthless. I keep the net credit. It was only one commission to enter the trade. In the bull call debit, If the stock's above both strike prices, you may have to exercise the long to deliver the short. Your broker may close it out for you, but you have to pay an extra commission in some fashion on the debit spread. It has to be closed for the profit. You may close ahead earlier, based on what the return that you've gotten been, but always remember that too. With a debit spread, it's a good trade. It can be good profits. Remember, you always pay an extra commission as opposed to the bull put credit spread if things work out the best, because the bull puts, the two puts just expire worthless. You don't have to do anything. In the call debit spread, you have to pay the premium. If you haven't done so, there's a lot of other presentations. I'll try to look for one for you, Ben. I know the longer one in the free webinars under option strategies is debit spreads versus credit spreads. So just go again, PowerOp.com, webinars.asp, and there's a comparison of the debit spreads versus credit spreads with an eye to the parity trade of a bull call debit to the bull put credit, and of course the bear call credit to the bear put debit. Sam has been commented in a moment ago. He said he's been doing really well with earnings this week. He made good profits on Netflix with the move. He did buy calls in JBNT and was out of them at 121, and the stock reversed. Second rally to 121. He's talking about the JBNT position. I did not. He says, did you buy Netflix after earnings the next day? He bought Netflix at 325, call in the mornings, paid $6, and then sold them when it got up to 337. When the stock was in the afternoon, calls were about 12 to 14. I did not play Netflix, but I did do an earnings straddle for today on Skechers, which worked out really well. Was it still one of the top losers today? Earnings announced, top stock gainers, top stock losers. Yep. 27%. I think I got out of that straddle. So what did I end up doing? It's a 42.50 on Monday. I bought a 42.50 call and a 42.50 put for about $4 and sold that for about, that's weird, it was about 11.40 actually when I closed it this afternoon. Naturally, the 42.5 call went to nothing, but the 42.5 put on Skechers went to 11.40, 11.30, I think it was 11.35. But I paid $4 total for the call and the put. So that was the only earnings play I made this week, and it turned out to be a dandy. It's because I was maneuvering other positions and I didn't pay attention. Calls at 50. Oh, good. Sam's also talking about MU. He's got 200 shares at 49. He also bought calls at 50 and got out when that peaked out at 54. MU today is almost back down to 50. That's the same thing I saw with Amet. Yeah, I played it purely as a V, as a straddle profit and loss chart, buying the call and the puts at the 42.5 strikes there on the straddle. On Tuesday, I think I actually got into Skechers, and I think my debit cost was $4.40, $4.60, and like I said, I got it. The put was about $11, $11.30 today, and the call naturally just went to zero. I wasn't trying to play directional. Okay, let me phrase that. I was playing directional, but I was just doing it as an earnings play to either side, which meant I'm doubling my costs and needed a much bigger move, and this one paid out well. But I've had ones that still moved 5 or 6% and didn't make a profit on the straddle because of the crush there. So yeah, I got in here, a couple contracts, we'll just put in one. I want to say on Tuesday this was 240 and this was 220, something along those lines. Yeah, so it's 460, 470 entry. There we go. And yeah, so it profited about $700 profit on the investment there. So that's the only one I did for earnings. And you emailed me about Netflix the day after the earnings, and also it was Apple that you were trading, and I was busy on something else, and I didn't look at either one of those, but I knew Netflix was going very well with the earnings. I think I was trying to do an adjustment on an Adobe ADBE calendar call spread. I was looking to open a calendar call spread on ADBE, and I decided to avoid it. Okay. Mark says, Mark had mentioned, does Sam do debit straddles or volatility crush iron condors? From what he describes to me, it's a little bit potentially of both, but he's swinging in and out of them. So at no point, yeah, Sam says no. At no point does he really have all four legs open potentially of an iron condor, or even all legs open of a straddle. He's sort of rolling with the market movements. as he had mentioned, closing the put, selling the close the puts at the low and buying a call, waiting for the growth up and to see the change and the technicals he does, and then he'll sell the call and buy the put. And if he thinks it's dropping, of course, he might sell the call as he buys the put to get the extra premium there, and then looking more for a trend. So he's legging in and out. He's probably not in 4 open legs of a position at one time, although a lot of the positions, I know Sam has the stock in it too. A few of the positions, Sam, you have the stock in too, and you're maneuvering the straddles and calls and puts around it. So I call it a straddle in these discussions, Mark, when Sam puts in his commentary on his trades, is because in one day he might have been in a call, a put, in a different call, and in a different put, but not all at the same time. It's I don't want to call it, it's kind of like day trading, but it's not day trading. It's trend trading in a sense, and that's what Sam does, and he's been doing really well with the positions. He's got his sort of technicals down pat there for that, what he looks for in the daily charts and things of that nature. All right, let's see here. Yeah, SQ, Sam says he's been doing really good at. I haven't checked the chart on that one since, what was the last time we talked, 2-3 weeks ago? Yeah, it's at 51.46 now. You got in at 45. So that one's been one that's sort of been up and then took the 20th hit with everyone else, but he got it here down at the bottom. No, you caught it before I would have. I probably would have bought here at about 47 or 48 when I saw the excuse me, folks, the trend change. Unless you might have gotten in back here too. Yeah, you might have gotten in back there too. Sorry, I didn't realize that. Yeah, I just bought the puts today on it. Okay, gotcha. Because you're not sure. Yeah, this trend is showing. Well, it's still going up a little bit. So it's for longer term. If it hits 55, it'll probably pull back down. And that's where Sam has the puts, or the 54, I should say. All right. Well, ladies and gentlemen, here we go. Yeah, essentially MACD is what we talk about, and there's other things we use as well. Personally, well, I use MACD mostly. We'll look at RSI as a confirmation signal as well as the Bollinger Bands. I can't speak for everything that Sam does, but a lot of the times when he sends me a chart via email, I see the MACD. When he shows me where he's jumped in, I see the MACD change on that as well. All right, well, ladies and gentlemen, here we are, 6:15 Eastern Time. I don't see any other questions come in. I think I got to most of them. I think I got to all of them, I didn't want to say, but if I did miss a comment or if I did miss a question that was sent in with that large group of the others, if I missed your comment or your question, just let me know real quick. I'll be more than happy to share that with the audience. Everyone, remember, today's material is my thoughts on your questions, conversations I've had with customers in the past week, and of course the question that came in via email from John B. They're designed for educational investment purposes, increasing investing performance and options knowledge. No stocks or options discussed today should be taken as direct recommendations or suggestions. So no stocks, or we should say any stocks or options discussed today, should not be taken as direct trading suggestions or strategy performance. I will tell you what my fears are with risk in a trade that was brought up there by Harvey related to iron butterflies, why I don't trade them. That doesn't mean I'm going to do an iron condor on that position either. Options, of course, do involve risk, may not be suitable. And I forgot to edit this from the last time we did this. Markets were closed on February 19th, but they will be open on April 27th, next Friday. So we'll be back here again at 4:30 p.m. Eastern Time as well. If you haven't had a chance to test out PowerOptions, remember, just go to PowerOp.com, put in your first name, last name, and email address, click Start My Trial Now, and we'll get you started for the 14-day free trial. You have full use of the site, the tools we showed today, such as the search tool, custom spread tool. We talked about the signature tools there, the chain, spread chain, plus the portfolio we didn't look at today and others. All yours, 14-day access, no credit card required. And then, of course, after that, our subscription levels start at $40 per month for the end-of-day service. We have different levels of service to match your needs for delayed, real-time, and more. You want to check out other free stuff? Remember, you can visit our blog at any time, blog.powerop.com. A lot of educations there on the webinars. Just go to powerop.com/webinars.asp. That's under the options concept section. We discussed the double-edged sword, implied volatility, double-edged sword presentation, and also we discussed the credit spreads one that was in the option strategy section for comparing credit spreads versus debit spreads. And You can always check us out on YouTube, PowerOp.com. I put up something fun yesterday on YouTube. There, it's just a quick 2-minute sort of overview video of the 7 ways to manage a bear call credit spread. So no speaking, just words, talk, pictures, one of those nice little 2-minute flash screen slideshow presentations for you with some fun music in the background. So that's there on the YouTube channel too, the most recent upload. This webinar was recorded, will be posted probably Sunday or Monday, and I'll send you an email when this is put up as well. If you have any other questions that you didn't that you think of later on, remember, send me an email to support@powerop.com. You can also reach me at support@radioactivetrading.com as well. Of course, you can also call us during market hours at 302-992-7971. And of course, trial members and subscribers, you can always schedule one of those coaching sessions, essentially a free 35 to 45-minute phone conversation with myself or Ernie, walk you through the tools on the site and answer any questions that you have. Sam says, thank you, fantastic session. Have a great weekend, or happy weekend, Sam, you too. I look forward to seeing you next week. Ben also says, have a great weekend, Mike and everyone. You too, Ben, take care. Thank you for your questions. Mark, I wanted to mention to you, of course, that if you do call us up or send an email, and Ernie or myself do answer the email, we will tell you that the main things that we structure on big charts when we are looking for the search and power options is we'll customize it to look at the Bollinger Bands, MACD, RSI, usually on a 3-month chart, and we may do other analysis, but that's how we set up the chart. Ernie's my main focus is on Bollinger Bands, MACD, and of course a little bit of the RSI as a confirming signal for myself. I think Ernie uses it more than I do. But also there's other criteria out there. I know there are other indicators and oscillators and things of that nature. And yes, I do use the MACD as well to for exits and trigger points for my earning as well. Okay. All right. Okay. Yeah, Sam says he likes to be here to earn and learn, and we like to have you here too, Sam, because you teach me stuff too every week, and you help out with the comments of other questions that come in. Of course, I appreciate everyone being here because I learn from all of you, and I hope you learned something from me. Take care, everyone. Fantastic weekend. I hope to see you next week. Good night.